Hi, Tori Agler with McIlvaney Precious Metals. It's July 1st of 2025, and I'm here to give you a second quarter recap, not only on the precious metals, but the markets that are closely associated with the precious metals. And it's been a fun one. I really would call this quarter the quarter of the white metals. We saw a resurgence in the white metals, playing a little catch up with gold, and we'll get into some of the further numbers. And as always, I want to make sure that we're sharing screen and have the opportunity to give you some of the details in images rather than just listening. So without further ado, we're going to jump right into some of the charts and the pictures that will help get you updated. All roads lead to gold, right? Now, I've said that over and over again, and I want to kind of review the fundamentals for gold. It's certainly uncertainty in the economy, which has really kind of settled down here as of late, but certainly fiscal irresponsibility, loose monetary policy, geopolitical tensions, and then ultimately fear and greed, which can be just leverage in the market. So as far as the economic update, the picture has actually gotten a little bit rosier. The term Trumpageddon, the demise of the economy as a result of tariffs and some of the economic policies that the president was taking on with his administration just has really not materialized. So negotiations and agreements have calmed the waters, if you will. But this is just a picture of the quarter of just the Dow Jones Industrial Average. So nice upward trend. Now, I hate to say that the equities markets are an indication of economic viability. I don't like it in any direction. I don't like to hear people claim that the stock market doing well means the economy is doing well. That's not necessarily the case, but this does add to consumer sentiment. That's a great chart. Here's the S&P 500 over the same period of time. Obviously doing well. In fact, the S&P 500 for the first time crossed 6,200, so all-time high. Same thing. Now, this draws out a little further, and look how long that chart has been going up. That's actually an indication of a depreciating US dollar as well, that all assets have to adjust for a depreciating dollar. It just doesn't quite catch up with what gold has done. The S&P 500 did have at least a 15% decline, and what you'll see, it only took a very short, less than 100 trading days in order to regain and go set a new high. So that's the quickest recovery on record following a decline of at least 15% in the S&P 500. So maybe you could say, well, it really shouldn't have come down that far, and we're kind of getting back to where we should based on fear. But all that being said, excellent recovery in the S&P. And here's the NASDAQ, similar sort of a trend over the course of the quarter, really strong stock market trends. And drawing out a little bit further, again, the NASDAQ as well, just like the Dow and the S&P stocks have adjusted to a declining dollar. Most of the time, 72 to 74% of the time, you'll see gold and the stock market move in opposite directions. Okay, so the fact that gold stayed strong with those stock market charts looking the way they do is actually very bullish. And some of that has to do with geopolitics. There are a lot of fundamentals that move the gold price, not just the stocks, not just the dollar, not just geopolitics, not just bonds, but all of them, along with monetary and fiscal policy. So anyway, this is a good image that just shows there's a big chunk of the time they're not moving in the same direction. All right, so economic news. To the downside, consumer spending has faltered, right? So we know that people have tightened belts. There's been uncertainty in the markets. You may be feeling it yourself, and that discretionary spending has tightened to a very, very low level, lowest level actually in many years. To be less than 1% is pretty bearish on the economy. Long-term bonds, heavy redemption, so people are leaving bonds and moving into gold and other flight to quality type of assets or flight to safety assets. But gold has really taken charge, and you'll see it's a rare event, but it has happened and it's happening again. The 64 rate cuts so far this year around the world, that's what this chart represents. There's been 64 different central bank rate cuts. In the United States, there have been zero, much to the chagrin of the president. And, as he name calls Jerome Powell, the chairman of the Federal Reserve, too late, Jerome, or too late, Powell, that's not going to help. It's become a very politically divisive, confrontational environment, if you will, between the Federal Reserve and the White House. And the president wants lower rates. He says that the economy is good, but he wants it to be even better, and believes that from housing to automotive, just basically consumer borrowing and spending would ramp up. The problem is that the inflation numbers would also ramp up, right? We've been there and done that, and it's a tightrope that they're walking. But all that being said, a lot of rate cuts around the world. It's just not in the United States. They do still believe that there will be 1 to 2. When the Federal Reserve cuts its lending rate, gold does tend to rally because that's weak dollar policy. So look for at least a couple more cuts later in the year. Some of the key economic numbers, I highlighted the yellow because they're higher, right? So we started to see inflation come down. Now we're starting to see it creep back up. So consumer prices are up. This is as of May 2025, but the CPI core is up 0.1%. You'll see housing utilities are up, transportation's up. The CPI, the Consumer Price Index in general, is up. Okay, so we're starting to get this 12-month rolling average, and inflation is going to pick back up. And the concern is really on the GDP side. It's not going to match, and so that's got the Federal Reserve frozen on the sidelines. But you'll see inflation rate is at 2.4%. The Fed has a stated objective of 2 to 2.2. And then the PCE and the PPI, those are the key ones that the Federal Reserve is looking at, and those are climbing. So as long as those are going in the wrong direction, there will be continued resistance to a rate climb. Oil has had this long-term, this is a 1-year chart of West Texas Intermediate, the oil price, and you'll see we're at 65. This spike here was the Israeli-Iranian tensions increasing, obviously, in the war breaking out. And so we had this aggressive spike, and it's come back down. But you do have this kind of upward trend. Gas is cheaper at the pump, and that helps the U.S. consumer. But all that being said, 65 is probably a good line where there is some production, some manufacturing, not yet some resupply of the reserves. He said he'll wait for a more opportune time to do that. But manufacturing production index increased by 24%. Okay, so you'll see here a ramp up from January and up. The manufacturing production index is looking rosier. Same thing with the labor market. Both of those, again, the labor market and what have you, speak against a rate cut as far as the Federal Reserve is concerned. But unemployment stays steady at 4.2%, and you've got wage growth at 3.9% year over year, hopefully keeping up with inflation, even though it's not really accurately reflected. All right, that's the economic. What about the fiscal? In a small picture, 37 trillion now in our national debt. So since the end of last quarter, when I gave this update, the national debt's up 378 billion in the quarter. The federal debt to GDP ratio now is 123% and continues to climb, meaning our economic productivity is lagging, or is certainly lagging the debt. So the debt is growing faster than GDP can keep up, to the tune of 123%. And unfortunately, our annual budget deficit is over 2 trillion, which you'll see in this number here, the U.S. federal budget deficit. And that equates to this negative number, which is 1 trillion just in interest on that debt. And that's unsustainable and very dangerous for keeping the house in order, if you will. So the primary fiscal concern, and I'm not going to go into a deep dive, I will just say that from a timing standpoint, right now, it's all about that one big, beautiful bill, and it is going to raise the debt ceiling by 4 trillion. And unfortunately, the Congressional Budget Office estimates that by 2035, that national debt will not be where it is here at 37 trillion, but rather at 59 to 62, and that will be a doubling from 2021. And again, a very unsustainable path. Monetary update, picture of the quarter is the US dollar. This is just a declining pattern in the dollar index, and you'll see that this is, again, just in the quarter. I'll zoom out here in a little bit, but we're well below even the moving averages. They can't keep up with the rate of decline in the US dollar. We're now below 97 and no end in sight. The lower that dollar drops, the more gold has wind in its sails. Okay, the gold chart would be the mirror opposite of the dollar strength. Okay, here as I zoom out a little bit, we had this dip and we had the US dollar this dip here, we had the US dollar rally about 10% after the election as a result of optimism. And then since, just like with Trump's first term, he wants a weaker dollar. He's getting a weaker dollar, and you'll see that steady decline. And it's really kind of a continuation of the decline that had been occurring already. But that weaker dollar coming off of that 110, I mean, we're down almost 12% just in 2025. So we're also seeing, because of that weaker dollar, and people fleeing bonds, we're seeing a flight to gold. So as you see U.S. Debt in terms of the global reserves, like what people are holding, are they holding U.S. treasuries and bonds, or are they holding gold? Well, the gray line shows that they're holding fewer and fewer of our debt assets, and they're holding more and more gold. So the primary beneficiary of what that is called is de-dollarization, like fleeing the US dollar, is gold. And that's a trend that will continue until you see the dollar stabilize. And so that's very bullish for your gold holdings as well. All right, so let's finally get to the precious metals. In the quarter, this is still a great chart. I mean, gold for the quarter gained 5.7%. All right, so it looks more than that, but where we started the quarter at a little over 3125 and closed the quarter at 3,303 essentially. Okay, so that's up 5.7%, and that's great. But if you zoom out, you'll see just this year over year. This is a 1 year kind of July 1st to July 1st chart. Gold's up in that period of time 41.5% on this chart. That's incredible. And obviously that's aided by this climb here of 25.6% so far just this year. It did finish up in the quarter, like I said, 5.7, but that's 41.5%. And that's following 27.3% in 2024. So this is an ongoing trend and not to be expected to continue. It just depends on if they get the fiscal house in order. But we're up 98%, almost a double just in 5 years on gold. The reason I'm bringing this 1 year chart in is I want you to see where the moving average is. So the green is a 20-day, the blue is a 50-day. So the average gold price has been climbing, but the red is the big dog, and that's the 200-day moving average. And we've come down below the 20-day and the 50-day moving average. So we could be seeing a little bit of a pause and a breakdown here. And when that happens, you'll see that you can sometimes inch closer to it and oftentimes even touch that 200-day moving average. So it wouldn't surprise me if we do see a pullback. This would be the time of year, July, June. It didn't really happen, but into July it certainly could, and we could see it come down into the lower 3,000s. And that doesn't mean an end of the bull market. That's actually forming a base, and it's going to resume its climb. So here's the long-term chart going back to the 70s on gold. This is why you own gold. You don't own gold because of all the geopolitical reasons and political reasons and everything else. You own it because of monetary policy and what the US dollar weakness has done. And this long-term chart is what it's done over your lifetime. And I really don't see that without taking, with the exception of a few pauses, I don't see that ever really changing. All right, so what is not happening is there isn't a huge retail demand in our market. In the coins and bars world, we're not seeing a ton of demand. In fact, it's a weaker demand. There's big money moving in, but the gold price has been driven by institutional money, the Eastern investor, really not the Western retail investor. It's central banks and big money. So this just shows a drop in demand for the Western retail market in black and other retail markets in blue. And you'll just see what this equates to actually is a softening in premiums. So even though gold is $3,330 an ounce, you're paying what you would have, a year ago when things were at a higher premium. Silver, we're seeing the same thing. So take advantage of the low premiums in the market right now, especially for premium plays where we're compounding ounces. And I'll get into some of that in a little bit. All right, here's the quarterly chart on silver. You'll see again, very beautiful chart. Silver's up 6% on the quarter, but right after the start of the quarter, it came down to below 30. So that's a little deceiving. Silver's had quite the run. It's up 24.7% in 2025. So just starting from this point here, if we zoom out, we actually started last July 1st, a little bit higher than where we started this year. So it's up 21% year over year, 21.1 to 22%, with 21% occurring in 2024. Okay, so again, back-to-back very solid years, not to be expected as the norm. Silver has more than doubled. It's up 106% in the 5 years, and really has kept pace with gold, and people don't give it much credit for doing that. You'll see here we've come above the 50-day moving average after having broken below it. We even came down and touched the 200-day moving average right after the start of the quarter, and only to see it rally and now separate again above those moving averages. This is an indication down here, this downturn and this below the trend line, remember that silver is oversold, that it's actually a buyer's market. And that's actually a nice indication that it is safe between the ratio and that you could be adding to the ounces. If we did see it pull back, $38 is going to be a line in the sand for us, right? If we can close above 38, that's going to be a hard ceiling to break through. And we've been saying that for years. We're at a 13-year high in silver, but if we go and test that and we're unsuccessful in breaking through, here you'll see some of the pullback points that it could come back down to. But for now, $35 is a strong line up to the downside, 38 to the upside. We're chopping in the middle there, and I'm as anxious as anybody to see what transpires. The metal of the year is platinum, so let's transition over to that. Here you see the quarterly chart, very aggressive. Quarterly performance for platinum up 34.1%. That's pretty remarkable. That gives it a 47.5% climb in 2025 so far. And as you can see by this parabolic chart, it's nice to see this happen because this sideways chop goes back many, many years. And some of you have been long suffering in your platinum positions. We tend to put 5 to 10% of a precious metals portfolio in platinum, especially in IRAs. And we're finally starting to see that. So it's time to discuss that in your portfolio with the performance of platinum, silver, and even maybe palladium and moving that over. You have to look at that as, is that a speculative performance-based asset, or am I looking to ratio trade that at a later time? And I'll show you why I mentioned the ratio trade. Here's again the moving averages. Look how high above the moving averages we are there. That tells me that we're a little bit overbought, as does this upward trend here and the sustained above average line here. So to me, platinum's due for a little bit of a breather. I don't want you getting caught on the sidelines. If you do want to sell some, let us know. But here's the important piece: platinum divided by gold. So if you take the platinum price and divide by gold, you get a ratio. Here at the top, it's like 2.4 times the price of gold. And you'll see that from goodness, just all the way from 1986 all the way to 2015, platinum tended to be at least equal to the gold price, okay, if not twice the price of gold. Well, now we got down to less than a third of the price of gold, and it's come to life. It's about 40% of the price of gold. But what I want to see happen from a ratio trade is that when we get back to this 1-to-1 line, that's when we'll sell our platinum and move into gold, and we'll pick up, if you have 3 ounces of platinum right now and it only equals 1 ounce of gold, later those 3 ounces of platinum will get you 3 ounces of gold, and that's how we build your portfolio through compounding ounces. And the reason platinum's important is, look, the gold value is 23.1 trillion, the above ground gold supply, 23 trillion. Silver is only 340 billion, a much, much smaller market. Gold dwarfs it. Well, silver dwarfs platinum, $3.8 billion in value in terms of the above ground stock of platinum. So it is far, far, far more rare than gold. And that's why I feel really good about the fact that at some point it'll come back and reach parity. This chart shows where it's mined. South Africa and Russia dominate. So because of the geopolitical uncertainties and unrest in those 2 regions, you'll see a lot of volatility. The next is Zimbabwe. Doesn't help paint a better picture, right? So we're waiting to see if that's a trigger that drives platinum higher on a speculative deal. But even without that, you have a huge decline in platinum going on just in terms of mining supply, right? So from 8,309 tons down to 7,002 tons, you're getting this not only decline, but in this next image, you'll see it's actually a deficit. So the physical demand for platinum now for 3 years in a row, if we are accurate in the estimations, 3 years in a row, you'll have a deficit in meeting demand, because the supply is not keeping up. And so that paints a rosy picture and really probably a realistic picture for what platinum is doing as of late. But it needs economic revival, and we'll get into some of that. That's what the Trump administration is trying to do, is economically revive and have an industrial revolution. And if that happens, then all the white metals will continue to run, especially if you can get GDP to increase with inflation. That's going to drive these prices higher. All right, not to be forgotten, palladium up 19.6% so far this year. Over the course of 12 months, which this chart shows, it's up 12.5%. And so even though it had a significant decline from its previous highs in the 3,000s, at least it's appearing as if it found a floor. And here you'll see it dropped below. This is a kind of a trading anomaly here, this little spike, but just think of it around right now, current price about $1,120. Okay, and here you'll see a better indication of that on the quarter, what has transpired in palladium. Nice looking chart like the rest. All right, so here we have the Dow to gold ratio. I pointed this out last quarter. It's something that we track. And in the quarter, we did see it get as low as almost 11 to 1. But when we're in single digits, that's when you'll start to think, okay, maybe my gold is overvalued compared to the stock market. But with the recent stock market rally, it's gone back up to 13.3. That tells me that either we're still awaiting the significant stock market pullback, or that gold's pause has been short-lived and is due to resume. But I do believe that we're heading into the single digits on the Dow divided by gold ratio, and we'll see what transpires. Again, 13 to 1 now. In bear market bottoms, we've seen it at 2 to 1, 1 to 1, 6 and 7 to 1. Again, we hit 11 to 1, so even lower there, and anxious to see what transpires again there. And this is just it for the quarter. This is the gold to silver ratio. All right, so if we take the gold price, divide by silver, a lot of you have been watching that. We did get to about 104.7 on that ratio. It's come down to 91.5. And so that's about, obviously a 12-point decline in the ratio, 13-point decline. And that may be a trend that's continuing. We'll have to see. Anybody that bought silver so far this year, you're hoping that continues. Certainly normal as we zoom out here to have it come down into the 70s, 80s, right? Just into this range here. And so I do think that that's going to happen. I just don't know if we're going to get another one of these spikes, or are we going to continue on down? If we continue on down, then that means we're selling silver and buying gold in your portfolio, just like we're buying gold and selling silver when this is coming up here. We're selling gold and buying silver. The higher this gets, we're going to go the opposite direction, the lower this ratio gets. So we've got eyes on that. And the whole point being is that we can compound ounces by doing so. This is a real example of starting with 10 gold coins. Give this about a 13-year time frame on this example, but going from 10 ounces of gold to 24 ounces of gold without adding more money works great in IRAs. And all we're doing is moving gold to silver, silver to gold, and just playing that ratio like a seesaw and compounding your ounces. Here's again a little better example of zooming far out on that ratio and just how strong it still is a buy silver type of a signal here at 92 to 1. So don't give up on silver. All right, ETF demand, we're finally starting to see. I wanted to show you this chart because we're finally starting to see the Western market move into gold. Again, we talked about the fact it's not the retail investor, but it's large institutional money that's driving the gold price. And as you can see, it wasn't the West. Now it is. This is North American ETF demand. And this is getting exciting. And when the retail investor steps in, that's when I think the prices really are going to resume. And we're going to go test that $3,500 level in gold. We need to close above that 3,500 level, just like we need to close above $38 in silver. and then things will be in a new paradigm, a new story of the building. So I hope this has been helpful. As always, we just really appreciate you and encourage you to call me or Eric or Deanna at any point if you've got individual portfolio questions. And if you want to talk about your own individual portfolio, call us at 866-211-8972. We look forward to working with you over the next quarter and the rest of the year. Enjoy your summer, and God bless.